In today's video, we're going to take a look at Friday, September 15th's volatility activity inside of the 10 major futures markets that we look at. This includes the S&P, the Dow, the Nasdaq, and the Russell, which are the four markets we're going to focus on in today's video. Now let's get started by first reviewing our morning volatility note, which looks something like this. The morning volatility note is something that really helps give you a landscape of what does volatility look like in the 10 major futures markets we look at. Like I said, this includes the four major index markets. It also includes the 30-year bond, crude, natural gas, copper, gold, and silver. So that is the 10 markets which we look at every single morning, trying to determine, well, what is today's volatility landscape? Now, on Friday's case, this is what the volatility looked like. If we zoom in and we focus on just the index markets, and we plot them on our line graph here, here's where the volatility ranked. The Dow and the Russell were on their scalper Volatility Box models. If you look at this ranking here, it tells you very clearly that the scalper is the most aggressive model we have, which means the Dow and the Russell had the least volatility out of the four major index markets. Next, we have ES at Doomsday Aggressive, which tells you that the volatility in the S&P 500 was 2 notches above where the Dow and the Russell were. Finally, we have the Nasdaq, which was even one additional notch higher, essentially one level short of our most conservative model in the Doomsday Conservative models. So if we had to rank the volatility in the four major index markets, the Dow and the Russell would be the least volatile, the Russell was the most volatile, and the S&P was in the middle with essentially the middle volatility between the two major indices. Now, armed with that knowledge, we'll go to our charts, but what's interesting is you'll see that the volatility in the Dow very much caught up to the S&P and the Nasdaq, which is sort of what we expected to see happen here. It's not often that these markets stay in different routes in terms of volatility to end the day as well as start the day. They usually end up converging at some point, or at least getting pretty dang close to the volatility of one another. And that happened on Friday's activity as well. Now let's get to our Thinkorswim charts and review the trade setups which triggered. Let's start with the S&P 500, which was on its Doomsday Aggressive model, which we can see right here inside of the note. Now, in our Doomsday Aggressive model, the breach which triggered took place between the 10 to 11 a.m. Pacific hour. Now, this is what we call our fade setup, and I'm going to go through the rules a little bit slower for those of you that are, say, newer to the fade setup. There's two steps that we're looking for. Step number one, we need to see a volatility box breach. That's either side sign entry lines getting breached by price action. So here we can see as this sell-off takes place, price breaches our lower sides volatility box sign entry lines, and that's step number one. That's what we call our volatility box breach. Step number two is we're looking for this edge signal confirmation, and the edge signal are these green arrows that you see on the chart along with the red arrows. That tells us we're in either overbought or, in this case, oversold territory. So now we know we're looking for a reversal, and that's step two of our fade setup. We want to see a volatility box breach, and we want to see the edge signal confirmation. Once we get both of those, we're looking for an entry at the sign entry line, or better than that, our stop is outside of the volatility box clouds. In the case of the S&P 500, that was a bare minimum risk of right around 5.25 points. That's from the sign line to the outer edge of the clouds. And we're looking for that same amount for our first target, which we hit in this green candle right here. Now, our second target is at the opposite side's target line, which we did not hit in Friday's activity, but that was 11.75 points away. And you can see how price activity ended up shaping after we hit that T1. We pulled all the way back and essentially just chopped to close Friday. Now, the reason I find this activity somewhat interesting is we can very clearly see that the buyers still did hold this level to close the day. So there was some little bit of strength there to close Friday, or at least some defense if you were to call it. Now, if we move on next to the Dow futures, the Dow futures, remember, we're on their scalper volatility box models to start the day. And you can see how that volatility very quickly picks up in that next hour. The 7 to 8 a.m. Pacific hour, price breaks outside of the clouds. That tells you that, hey, you can no longer scalp. We need to be a little bit more conservative, so we try and adapt to the volatility. Now on the aggressive volatility box models, in that same 10 to 11 a.m. Pacific hour, you can see we have a breach, but we don't see an edge signal prior to price action going outside of the clouds here. So one more time, we adapt, and you'll see that now the Dow has caught up to the S&P 500 on the doomsday aggressive models. Now the same setup that I just talked about inside of the S&P also triggered in the Dow. First, we had the volatility box breach, then we had the edge signal confirmation. Here, if you took the entry right after, you were able to even shrink your risk down further. However, using the actual cyan entry line and any price better than that, our bare minimum risk on this trade was right around 35 points. That's from the cyan line to the outer edge of the clouds. And that's what you're looking for on the other side's target as well, which the Dow hit fairly quickly. Now, if I zoom out, the Dow fell short of its second target line by essentially a few ticks. This is the target line right here. If we extrapolate that, you can see how price action reacted when we got fairly close to that level. So that's the Dow. Now we move on to the Nasdaq, which was on the conservative volatility box models. So the Nasdaq, remember, was the most volatile, and it didn't really give us any opportunities. We were trying to be a little bit extra greedy here, and price almost fell to the cyan entry lines in that same 10 to 11 a.m. Pacific hour, but didn't fall quite as far enough. And finally, the Russell, which started off on its scalper volatility box models, you can see just like the Dow, ended up in that 7 to 8 a.m. Pacific hour going outside of the clouds. And that then takes you to the aggressive volatility box, which didn't give us any breaches for the day. So the two breaches which met the rules of the fade setup were inside of the S&P and the Dow futures, both of which we took a look at in today's video. Now keep in mind, these trades did take place in that post 10 a.m. hour when we're not really looking for new trades on a Friday, so they didn't meet the trade plan rules, but I do think it's interesting to call out, still study these trades, because we can understand how volatility tends to react as the day goes on. We can also study some examples of fade setups in markets like the ones that are less volatile and catch up to volatility. And we can also see how this different volatility regime ends up shaping our directive early on in the morning. I hope you found this video useful for all Futures Volatility Box members. Take care, everyone. Good luck trading, and I'll see you in our next update.